All right, hit it.
It's Friday, May 3rd, 2024, episode 238. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, Jenny Hadiaris, head of market structure from TD Cowen, and Peter Haynes, head of index and market structure research from TD Securities, join us to talk about the evolving state of markets. They explain algos, how trading has changed, and what it might look like in the future. Then Patrick takes the crayons out of his mouth to do a little analysis in Talking Charts.
And then we end with Krayons with Kev. And folks, we might even drink some beers along the way. Danny, hop on. What beer am I drinking this week?
Today, you are drinking the Mundo Maya India Pale Ale. This beer is somewhere between an American and English style IPA with an addition of local fruits that make this beer in a class of its own. Clean forward malt flavor with fruity esters and a citrus hop finish.
The first sip is actually pretty awesome. I will rate it at the end. Kev, give us some side effects, buddy.
It's your favorite drink, beer. All right. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much huddle may include the GDP giddiness, feeling overly elated every time GDP slightly increases, followed by the immediate despair when reminded about inflation. The fiscal flu, experiencing sudden chills and fever when overhearing the word recession. And then finally, the layoff laryngitis, losing your voice every time there's talk of rising unemployment rates.
Oh my God, that's I'm going to suffer that laryngitis for sure. All right, let's get in an interview.
Well, it's our great pleasure to welcome to the show two market structure experts. We have my good friend Peter Haynes, who is, I don't even know what his title is. He'll tell us later, but also lucky enough to have Jenny Hadiaris. She is the head of global market structure at TD Cowen. Let's start with you, Jenny. Thanks for being on the show.
Thanks for having me.
I know Peter really well. We're going to go through his background a little bit, but I'd love to learn a little bit about yourself. Let's start with, where did you grow up?
I grew up in Maine, born and raised.
And so you're almost, I was laughing, you're almost a Canadian naturally.
Yeah, I think technically I might be north of you guys.
Oh, that's true. People don't realize that actually Maine is actually much farther north than that. That is great. And now you're right around Kennebunkport. Did you hang out with George Bush Sr.?
I have been to their house. Yeah.
Oh, you have?
Yes, the Bushes they were lovely.
Oh, that's nice. All right. So now, when you went to school, what school did you go to? And did you always have dreams of being a market structure expert?
No, I didn't know what I don't think anyone knew what market structure was when I went to school. No, I went to Harvard in 2001 to 2005. Okay. And I think I wanted to come out and be my first job out of school was at Forbes. I thought I was really fancy to be in magazines and marketing and that sort of thing. So that's how I started my career.
And so when you got a job at Forbes, and from there, how did you get transitioned to the sell side?
My uncle had introduced me to the man who was the head of equities at RBC Capital Markets. And after I had been at Forbes for a little bit on the .com side, RBC reached out, and I just really loved the team there. And at that point, I had realized that maybe print media and wasn't the place to be. And even the online media wasn't necessarily the place to be. And so it was a really exciting opportunity. And so I left and never looked back.
And so did you go onto the trading desk?
Mm-hmm.
And so
I started out as an admin on the trading desk. Okay. We were laughing about it the other day because I saw a bunch of old colleagues when I was out in Minneapolis, and because that was the old Dane Rauscher office, right. And we were laughing because I couldn't figure out my first year on the desk the difference between the hold and the release button on the turret. So I regularly clipped the CEO, the head of equity, the head of markets, in my first year when they called in. I was not great at that job, but did a lot of analyzing clients and revenues and trends. And it was right when Reg NMS was coming into place and where we were positioning the business. So it sort of evolved into a chief of staff for the head of equities.
All right. And so from that, you really didn't have a computer background or anything like that, but yet your job ended up being very technical and I'm assuming computers play a fair role. Like, how did you make that kind of using your degree, or you didn't use your degree, or did you just learn on the fly? Tell me a little bit about kind of the experience of having to be in such a technical job.
Yeah, it's really interesting because this is going back to sort of the Flash Boys days um, and the beginning of market structure. But I was working for the head of equities, looking at sort of the profitability of the business. And I remember we were looking one year at all of the fees and rebates that we were paying to the exchanges, and it was like, what is this? Why all of a sudden are these line items going through the roof? And it ended up being that, some of the economics of how people will route orders and what exchanges they send orders to was a big driver of how algorithms performed. And so that was sort of the nexus of learning about how orders are routed and handled for individual investors, for institutional investors. And then once you dug into the different exchanges and the fees and rebate structures, then you get into kind of like how the orders are handled. And then it quickly becomes very technical, and understanding that was a big part of what we did when we built the different tools that the institutional clients use. And so it started with understanding sort of the economics of the business, and it evolved into understanding the technology.
So you mentioned Flash Boys, and
Mm-hmm.
you basically overlapped with Brad. What's his last name? The fellow from the book. What was kind of your role in that kind of whole development of the exchange?
Yeah, I was at RBC, so I was on the market structure group. They built the exchange. They sort of started out when they built Thor at RBC, and so that was still the fundamental aspect of the trading technology. And when they all left to start the exchange, it was a great partnership. They're incredible. They continue to evolve and add to the landscape. And then, the team that was at RBC continued to look at the markets and incorporated IEX into the routing. And so it was a great partnership, and they're so incredible. I mean, I worked on the market structure team with Ronan and Ryan, and there's probably no bigger character in the market structure landscape than Ronan.
So they were Canadian. They were from the Toronto office.
Brad had worked in the New York office for years. He was like a tech trader initially on the position trading desk in New York.
Right.
And then Ronan was on the electronic team. Yeah. So we were all kind of New York based, but for RBC.
Right. All right. Let's get Peter into this. Peter, thanks for joining us.
Hey, thanks very much for having me.
So for those who don't know Peter is actually the original, the best index researcher out there. I remember from my days that when I used to work at RBC and we were wondering what was going to happen to the index, we were trying to pick which stock would go in, and we're kind of curious about different things. We would try to get our hands on this competitors research report, which was Peter Haynes's index advisory. I don't know what you call it, but it's been running for how many years now, Peter?
July 3rd, 1998, we published our first bulletin, and we haven't missed a single week since. So I guess coming on 26 years.
So you guys have been just absolutely fantastic. You've been leading the way in a lot of things, but let's talk a little bit before you got into that role. What was your kind of background? How did you get into this spot, and how have you lasted so long at TD?
Yeah, well, I asked myself that question a lot. Thanks for asking, though. I started at the stock exchange in 1988, and the TSE, that is, in Toronto here. And I was part of the index products group, which also had the derivatives products as part of the marketing group that was all under the same umbrella. And so I did grow up with an index background myself, and a colleague, Craig Hurl, who many people in Toronto will know used to be the head trader at Ontario Teachers. Craig and I were essentially the ones responsible for figuring out what was going to happen in the index, because at that time, all of the Canadian benchmarks were run by the TSE. And it was only in 1998 that they shipped them out to S&P. And so I grew up in that group and ended up leaving the exchange in 1994. And I got a phone call from a guy named Carl Belay, who was at TD at the time. And Carl said, "It's too bad you're leaving to go to Credit Lyonnais. We were considering offering you a job." And I went to the job at Credit Lyonnais in Montreal, and it wasn't working out. And so I was fortunate to be able to find a seat at TD just a year later, and started here 29 years ago, and I've been here ever since. And the role's changed, it's evolved, but I'm still involved in the index part of the business.
That's awesome. And you know what? I'm going to put you on the spot. We're taping this Friday after the market closes. Everyone's expecting a PXD, the S&P removal of the PXD. What do you think is going to replace it?
It's not going to be Dell, I don't think. But I do think that you're right. There is going to be an Exxon PXD announcement tonight. And so there's a few names in the candidate pool. I think our best guess, because financials is underweight, is that it's probably going to be Apollo. The technology sector, there's a bunch of technology names that qualify at the top of the candidate pool for the 500, but best guess is it's going to be Apollo because financials is underweight and the tech's overweight, which is interesting because in Canada, when we look at the Canadian benchmarks, financials are totally overweight compared to the broader benchmarks. So best guess is Apollo, but we're not certain on that. And again, that's just speculation on the street and going over the different names that are candidates for the index.
Oh, that's awesome. All right. So I'm going to talk a little bit about what we're going to focus on today. Now, I was explaining to Jenny earlier that I said we have two groups of listeners. One of them will be kind of institutional types that are very familiar with algos and how people use them, and they might even use them on the regular. And then the second group will be individual traders or traders that don't trade equities who are sophisticated but might not understand how these orders operate and how institutional orders get executed. And I was explaining also the fact is that then there'll be some guys like me that used to do all this in terms of institutional equity orders, but have no idea how the game has changed. So Peter, I'm talking to you. We'll start with you. Why don't you just highlight how these algo orders are used and let's start with what they are and how they're used.
Okay, that's. I think to do that, it's best, and Jenny will certainly chime in here because people, when they talk about trading, think that trading's the same everywhere. And the reality is, the market structure is different in Canada than it is in the U.S. And a very simple difference is that in Canada, when retail trades, all of the retail trades take place on exchanges, whereas in the United States, and Jenny can speak to this, almost all of the retail trades that take place off exchange. So there's a major difference between the two market structures. But when it comes to the institutional community and the use of algorithms are really a tool for efficiency for traders. And people always used to say, well, why would anyone ever want the VWAP, which is the volume weighted average price? Why would I ever want to be average in my execution? Well, the reality is it gives people the ability to spread trades out, to not necessarily put the pin in and buy a block of stock right where we are right now, because you're not necessarily sure if the stock is at the right price or at a price and you don't know where the direction of the stock's going to be. So oftentimes people will tend to spread their trades out over a period of time. And the various algorithmic tools that exist for institutions have been designed to assist traders on both the sell side and the buy side, because it is a myth to think that the only users of algos are the buy side. The reality is that our sell side traders will often use algorithms when they're managing the execution for their institutional clients. And so the tools exist. They've been refined over time. They're a little bit sort of made in Canada. There are some nuances about Canadian market structure, which we can get into, that differ from the US, not the least of which is the ability to interact at least a little bit in Canada with retail order flow. But I think, again, think of them as efficiency tools, and they're electronic tools that have been built by developers who are refining them constantly. And how are they refining them? Based on past performance. It's like anything else. It's almost like we're learning from every single time these products are being used and trying to tune them to make them better.
So Jenny, same question to you. Why do people use them and how do they use them?
Yeah, I think another big reason why people use algorithms is to help to minimize impact of larger orders. So why you see a lot of institutional investors using them is because they take a 1 million share order, a 50,000 share order, a larger scale order, and break it up into smaller pieces. And like Peter said, the sort of traditional first algorithm that came out circa 2001 was the VWAP algo, which took the amount of volume that you're trying to trade and spread it out over the day. And now it's really evolved to any sort of instruction that you could give someone. How do we build that into an algorithm? And what the algorithm does is just looks at what's happening in the market. It looks at a series of inputs and then makes decisions on when to trade. So you can have an instruction from someone that's, I think of it as sort of, if you're thinking from a retail perspective, like, where you would trade a stop order or a limit order. I would at this price. I would, I want to be more aggressive at these price levels or at this time of day. Any of those instructions that you could give can be built into kind of an automated fashion. And so a lot of what we do in algorithmic trading now is interpreting some of what people are trying to do on the institutional side into the algos and constantly evolve them as the market changes. So as more volume shifts to the end of the day, algorithms that are super aggressive in the last 5-10 minutes of the day, algorithms as clients want to look for more block liquidity, algorithms that seek out blocks at beneficial prices. You can really build any of that into it. And like Peter said, it's about helping with efficiency on the desk, helping people to manage a lot of orders at once, but also helping to blend those orders into the market so that larger orders aren't moving the market themselves.
So I have a story to tell you, Jenny. I still remember my first VWAP order that I got was sometime in the 90s, and it was from First Quadrant. And they told us about VWAP. They explained it to us and gave us this order. And we were like, are you kidding me? Like, we have to sit there and we have to divide the order up throughout the day. And it was just like, we hated them. We couldn't stand them. And I do understand why they did it. You mentioned VWAP. Why don't you tell people what it is? And then I heard a story that you told about you had a bumper sticker that said VWAP is for wimps. I love this. I was like, oh, I love Jenny already. Anyone that has a sticker like that is my kind of person. Tell them what it is and why, some people might think that VWAP is for wimps.
Well, it's VWAP is the volume weighted average price. So if you had I remember the first VWAP algorithm that I saw, quote unquote algorithm, was a spreadsheet where we had like from 9:30 to 9:45 do this percentage of the order, from 9:45 to 9 to 10 o'clock do this percentage of the order. So it was literally put the shares in cell A1 and we'll spit out how many shares you should be doing every half hour. That was sort of the original algorithm on the desk, but what the VWAP does is basically, it looks at the volume curve in a name. So you got a lot of volume trading in the morning, the intraday, in the middle of the day, it gets pretty quiet. And then you see a lot of names pick up at the end of the day. So you see almost this smile curve is sort of the traditional VWAP curve. And what you would do is if a client wants to trade 1 million shares, how do I blend that 1 million shares in so they generally follow the VWAP curve or the curve of the volume in the market? And you're looking to sort of match the average price that's accomplished throughout the day. If you took the volume weighted average price that traded throughout the day in the name, and that was kind of the traditional settings. And then it sort of evolved to now people are really, we overlap a lot with what Peter does now, where you're looking at the VWAP curve in an individual security. And when there's a rebalance day, that will shift the volume on the close and how much is done into the close. So the VWAP has gotten a lot more sophisticated. Why do some people say VWAP is for wimps? I think it goes back to what Peter said. Like, why would anyone want to be average? And some people would argue that if you just are looking to spread it out over the day, the larger order out over the day, then you're not necessarily having conviction in picking a price that you want to trade at. And especially, I feel like lately we've seen markets that sort of trend higher or lower throughout the day. So, depending on whether you're a buyer or seller, if you're a buyer and the market trends higher throughout the day, you might have been better off picking some prices in the morning and trading and having and executing earlier in the day. But again, some of this is just as someone that I work with says, sometimes you're the windshield, sometimes you're the bug. So when you spread it over the day, sometimes it works in your favor and sometimes it doesn't.
Well, and this is my big problem with it. I'm going to actually ask Peter this next question because I think that the world has changed and VWAP has become so much more prevalent, or algos in general has become so much more prevalent. And I think that a lot of times traders are kidding themselves about the true cost of the order. And meaning, like, I get it that you don't want, in the old days when you couldn't measure an agency trader's execution, like whether they were truly adding value or whether they were just crossing the bid offer and actually costing you money. It was difficult. It was tough to measure. And now we come up with this idea, okay, we're going to measure it against the VWAP and you'll be able to do that. But a lot of times, if you're a large portion of it, it ends up being a self-fulfilling prophecy And what I found more and more is like in the old days, as liquidity was demanded, stocks would actually be choppier. And now what happens is we get this situation where it instantly goes up in the first half hour and then just grinds higher for the rest of the day. Peter, could you contrast the old way of trading and the new way of trading, and whether you think that VWAPs are truly as efficient and as good as kind of the buy side believes?
Well, I think you got to start with the fact that the nature of trading has changed so much from the old days where you had relationships between the sell side and the buy side that weren't necessarily, as you mentioned earlier, measured. And the relationship between the buy side trader and his or her portfolio managers was distant. And now, with traders on the buy side being much more involved in the execution process, the idea of being able to measure them with the tools that we have available and technology has evolved, I think has become a bigger part of the overall execution process. Now that it's being measured, people are thinking about what are the best ways to execute. And when you think about the best ways to execute, the cheapest way to execute is if you can find another natural. Now, in the old days, finding a natural would often, and Kevin, when you were sitting on the desk, would be, I got 500 tellus to buy, go find me a seller. And the block desk would go around and try and find a natural and match it. The reality is that information that you just gave to the sell side trader is going to leak into the market and result in potential information leakage, and a stock's going to move away from you. So, as Jenny mentioned earlier, if your signal is not what's the stock going to do in the next 30 seconds, and you just need to buy stock over a period of time, and smoothing it out and being a small portion of the overall footprint in the market, not too much. And I would defer to Jenny on what those right percentages are. And it could even be down to the individual stock. But the reality is that if you wanted to just blend in with the market, I would say there is so much activity that remains VWAP oriented today that actually can end up finding you the naturals. And particularly, I think the area that I see it pushed the most right now is in the quant community, especially quants that have signals that are longer term in nature. And so they're looking to spread their trade execution over time to hide inside, call it the overall volume, and their signals are not short term in nature. And it's gotten to the point now where you're finding there's new facilities like PureStream in the US, which is an ATS that's actually matching up schedule-based trades like VWAP trades over a longer period of time. And it's naturals on both sides of the market. So I think in some ways, it's the combination of measurement, the combination of trying to find the naturals who happen to be in that sort of VWAP space caused by the quants, and spreading out the trades over the longer term. But I defer to Jenny. And what is, Jenny, your view on when you become the VWAP? I know we talk about different numbers, but I always find that that's an important stat to think about. Is there a rule of thumb, Jenny, that you like to talk to clients about?
It's really hard. It's really symbol specific because there's names where you can be 30% of the volume and it's all institutional and you're pairing off with decent liquidity. And then there's other names where you're 1 to 3% of volume and you feel like you're having impact. It's become, I think we've gotten to a market, we're at 11.6 billion shares in the US now. And if you ask any given trader on any day, they would say that it feels more like a 4 billion share day, that, 2/3 of the volume that happens is a lot of noise, a lot of, isn't necessarily sort of true liquidity. And so it really gets down to like the single stock basis where you have to determine like how much can you trade, looking at the tape, looking at who's active today, looking at how many naturals have printed, looking at how much retail is a factor in the name on any given day, to try and parcel out how much of the volume you see on the tape is actually liquidity that you can interact with. And that's, I would say, the hardest job of a trader these days, because you're trying to communicate to the PM who's saying like, I'm 20% of volume and I'm moving the name. Why is that happening? Or I'm 7% of the volume and I'm moving the name. Why is this happening? And that's the tricky part. But it really, choosing what percent you want to be and how active you want to be also comes back to, like you said, it's how much alpha do you have? Not every trade necessarily has alpha. There's a ton of trading that goes on, like you said, the quant flow, the transition flow. There's, where there's not necessarily short-term alpha in the trade, and there's a lot more people get indications from the PMs about how much alpha they think they have. And on average, if you trade slower, you will have less impact on average. So that's driven a lot of this sort of more passive participation in the market and spreading things over the day a bit more.
Okay, I got a question for you, Jenny, and one for Peter before I go on. So, Peter, is your argument basically that the old days of finding a block, of finding 500 on the other side is gone because everyone's doing VWAP? So naturally, there's almost no point in trying to trade that way because the other side doesn't exist anymore on a natural basis because the sellers don't want to stand in sell it at one specific time. They just want to VWAP it as well.
I think we have to think of trading from a buy-side perspective as the entire spectrum of tools in the toolkit. And I wouldn't want to suggest that standing still for blocks never happens anymore. And I wouldn't want to suggest that asking a dealer for capital doesn't happen, i.e. put me up on 500, tell us right now, what price do you do it at? I think it's tools in the toolkit. So if anything, I would say we've evolved from a market when you were on the sell side, I'll use that dinosaur era of the 90s, that at that time, it was way more about find me a block or handing the order off to the sell side and having the sell side trader manage that block over time. And today, the buy side trader maintains control of the information and just pieces it out to their various agents that are helping them on the sell side. So I don't think there's one rule of thumb, but I will tell you, Kevin, that the percentage of block trading in the market as a percentage of overall activity is probably at an all-time low. There are still strategic transactions that take place. Every once in a while, you'll see somebody come in who needs to get something done and a block will get put together and there'll be multiple sellers or buyers. So it still happens. But the role of the sell-side trader managing, if you want to call it on the block trading desk, has definitely evolved, and it's evolved to include all of those execution tools, including algorithms and the other tools that are available.
Okay, got it. Jenny, back to you. You said you kind of mentioned in a situation where a trader puts in 7% of the VWAP or the volume that's trading, and he's moving the market. Wouldn't that just be a case of, and this I guess is my big complaint about this whole VWAP trading, is that let's just imagine a whole bunch of clients are getting up in the morning and there's like 5 million VWAP to buy and there's 3 million VWAP to sell. And what's going to happen is that basically it's going to pair off kind of on the whole, they're going to try to match up. And then there's going to be 2 million VWAP to buy. And so the thing's just going to trickle up all day. And isn't that a case where someone would be better off saying, hey, listen, it looks like the imbalance is to the buy side. I should just, pay up and buy a bunch here.
I think what Peter said is right. Like, it's a different tool in the toolbox. You've got people that are willing to do 100% of their order in the morning. I would say the liquidity has become much more episodic in the market. So you're seeing, you won't do anything. There was an article recently that talks about like there's this many minutes in the day and only 10 of them matter. And they were talking about how much volume is aggregated around the close and how much more active people are around the closing auction. And then there's people that, a block print comes up and then what we see is like a flurry of trades around it. So like you can have nothing, and then just a burst of trading and a burst of volume. And that's people sort of executing those larger blocks and then people following along. And now that price discovery has happened and people are seeing where the print is, more people being more willing to participate proactively. And so it's really like, it's just a different tool in the toolkit. But what's fascinating now is even like, even the blocks are managed by algorithms to a certain degree. So there's a lot of execution venues that allow you to execute large orders, large blocks, and the algorithms will send orders to those pools. So when someone puts it in the algorithm, it doesn't necessarily mean they're just trading at 7%. Like there's all sorts of instructions you can put in there. You could say like, if it gets to this price, I would on the whole order, and the whole order will 1 million shares will execute in an algorithm in one print. So it's really about using all of those different things and interpreting the instruction and then building it into the algorithm.
Okay.
But yeah,
I get it. I think you said the other day that the displayed exchange volume has declined on a year-over-year basis, and it's actually at the lows. Could you explain to people what that means? And is that a function of pros like the Citadels of the world figuring out and sniffing out algos and trying to run ahead of clients?
I think it's been a natural progression. So yeah, off exchange volume is 44% of total volume. Even the non-displayed orders on exchanges are at all-time highs. So what you have, basically what that means is the displayed volume is like when you look at your quotes on your screen, what do you see as the best bid and the best offer? And that's becoming, much what contributes to those best bid and best offer that you see on your screen. Is becoming a much smaller percentage of the overall market. And part of that is like, as people look to minimize impact, they leverage dark pools a bit more. So they put their orders in some of these block facilities and dark pools because they were trying to minimize the impact of larger orders. And then the more that happened off exchange, the more it felt like putting your order displayed on an exchange or bidding out loud would cause impact in the market. And then it becomes like a self-fulfilling prophecy. The more you're concerned that displayed liquidity creates impact, the less you're willing to display your orders. And then the more people move to trading off exchange, trading in dark pools, trading with market makers like some of the ones that you mentioned. So it's really just been a natural fragmentation of the market and a movement away from trading on exchanges. But I think for the broader trading community, like as you sit and look at your phone, and or you're on an app and looking at what the best bid or best offer is, I think the concern is that those quotes and sort of the sidelines that we're all participating within are becoming a lot less informed, and a big percentage of the market isn't necessarily adding to the prices that you see on your screen.
Okay, in researching this interview with you guys, I actually learned something. I learned about an algo wheel. Jenny, could you explain to us what an algo wheel is and how clients on the buy side use it?
Yeah, an algo wheel is it's a way that clients send orders to different brokers. So the interesting thing is like VWAP's a relatively simple concept. You spread it out over the day, but there's a lot of different algorithms like be really aggressive, trade between this percent and this percent, and get a block if it's at or better than my arrival price. Like there's all different sorts of instructions. So basically the client outlines what they'd like to do with their orders. So I want to trade between 5 and 7% of volume and get whatever dark liquidity I can and block liquidity I can. Okay, broker, that's your instruction. You go do it. Build whatever you want within those parameters, and then I'm gonna basically bake you off against your competitors, because a lot of brokers have algorithms. And so broker A versus broker B versus broker C, you're in a horse race, and whoever's algorithm performs the best will get a bigger share of the overall order flow that's going out to the market. And I think it really started as for larger institutions. If you had some smaller sized orders, quote unquote, like easier orders, it was a really good way to sort of move those into a method of trading that allowed you to sort of optimize your best execution and get the best possible slippage versus arrival, create the least amount of impact, reward brokers who are doing more innovative things and whose algorithms are performing better, and then allow the traders to focus on the more difficult orders, the ones that are sort of tricky, and move the easier ones off their pad. So that's kind of what a wheel does. It's basically a broker horse race.
I like it. All right, Peter, 24-hour trading, is it a good thing?
Oh, it's terrible. I'm not a fan at all, in the sense that it is stretching out trading over a longer period of time and making it even more difficult for naturals to find natural liquidity. It is really born from the world of crypto. I think that Kevin, a space you obviously know well. I should, by the way, mention, Jenny, you failed to tell Kevin who your roommate, or not your roommates, who your classmates were at Harvard. Bring that back to the crypto world for us. Jenny, go ahead.
Oh, the Winklevoss. Yeah.
Oh, the Winklevi.
Yeah. So Jenny's got that in her back pocket. She knows the Winklevosses from the crypto days, but obviously the crypto world is what pioneered 24-hour trading. And when you have retail investors that have the ability to trade crypto on an app where they can also trade stocks, then they're wondering, well, why can't I trade the stocks the same way I trade crypto? And there's obviously been a push to have that flexibility built into trading, such that, and again, the argument you hear often is that I work during irregular trading hours and I'm going to do my research for investing off trading hours. I want to be able to put orders in at that time. But I think it's important to understand that the cost of trading overnight is going to be much higher than it is during the regular trading day between 9:30 and 4, because of the fact that there are very few participants that are involved at that time other than market makers. And so they're going to make you pay an extra spread, a wider spread, to be able to buy or sell a stock in the overnight trading session. And I think, generally speaking, where you see that space right now tends to be in more speculative vehicles like leveraged exchange traded funds, and maybe some of the larger cap mag 7 names, or even some of the more speculative names in the market. But I think there is certainly a push towards moving to 24-hour trading, and there is an exchange application that will be filed again with the SEC, if it hasn't already, by the name of 24-hour exchange, which I think is really going to cause some interesting developments in the U.S. market. Because as part of the launch of that exchange, if you in fact do have 24-hour trading in the U.S. with a U.S. exchange, then what's going to happen to prices overnight in that market? Are those prices that you see on your screen going to be protected such that you're always guaranteed to get the best price, which is something that exists today during regular trading hours, both in the US and Canada? And so will those orders be protected, and will there be a central security information processor, or SIP, in the US that provides those quotes to the general market that now runs 24 hours a day? And so these are the kinds of questions that are coming up. And again, Jenny, I'm going to just bounce back to you, because I know it's something that you're looking closely at. And you may or may not agree with my view with respect to 24-hour trading, but do you agree that it's a bit of a concern in terms of how things evolve?
Yeah, I think it's really new. And I also think, in addition to like the people who are used to entering their crypto orders overnight, it's also really, it reflects an international interest in the US market. So you've got a lot of people trading, a lot of incredibly active investors in APAC, in Europe, who want to execute orders and don't want to hit buy and not get a fill until the evening when they go home. And so that difference in time between their real-time market hours and our real-time market hours, and people looking for more 24-hour access to the market, it's really being driven a lot by that. So it's not necessarily like US retail investors, but it also reflects a lot of international retail investors, which, part of me is like, we don't have a lot of institutions that do a lot of pre-market trading. So even though like the markets in the US open up at 4 a.m., you don't see a lot of people trading between 4 a.m. and 9:30. There's just not enough liquidity that if you're really trying to do anything in scale, that you're going to be able to do it without moving the name significantly before the market even opens. So it's still limited among the institutional community, but in some ways, it concerns me. The spreads concern me. I think spreading liquidity out that's already challenging over more hours in the day is tricky. But in some ways, I do think a robust retail market has been a huge benefit to the US. And so having international investors looking to participate more actively in the US markets, especially, as I know, Peter, you touch on this all the time, as more international companies list in the US and people want to participate in those, in some ways, I do appreciate that you want to have that interest in the market from a broad base of international and local investors.
And Jenny, you make that point, and one of my colleagues here brought this up the other day about the shift in the number of companies that are redomiciling from Europe to the U.S., and these are well-known names in the European market, and that may, on a counterintuitive basis, be another reason why there is more demand for 24-hour trading. If you have Euro time zone investors that are seeing some of their blue chip names now traded in the United States, and they may want to continue to be able to trade them in their local market hours. So that may be another reason why there is a bit of a push more towards that longer trading day. Not that I like it for the reasons you mentioned, but that's an interesting aspect that, again, I don't like it, but it is something to keep in mind.
Carol, I'm going to jump in here again. Jenny, you mentioned the smile in terms of volume and the fact that a lot trades on the open and a lot trades on the close. I was wondering if the smile actually has some crooked teeth in terms of when the Europeans go? Because I know that we as proprietary traders focus on that moment as often being a change of trend. And you'll see, like, we'll talk about, oh, Europeans are closing. And I was wondering, it doesn't make much sense to me that they would put it in order for the U.S. market that ends at 11:30 or 12:30, depending on, what time zone we're in. But it seems to be that too often that does seem to be kind of a change in the things. First of all, is there a volume bump at the European close in New York? And second of all, do you think it has any effect on the markets?
No, we don't generally see the bump. If you like, most traders will say it's really, really quiet intraday in the middle of the day.
Right.
You do see a bump like the days where you see the crooked teeth would be like Fed days,
Okay.
Fed announcement days. You have to change your curves around because you'll see a bump right around the Fed announcement. You'll see other volume bumps around like energy names, DOE numbers, things like that, like events like that, news sort of things are what kind of drive it. I haven't seen a big bump around European close, but I will be curious to see. We have a big change coming at the end of this month, a move to T+1 settlement. It's going to be really, really tricky for European investors because they're going to have to affirm all their trades by 9 p.m. East Coast time, which is obviously the middle of the night. So will you see dedicated sort of resource and back office personnel from European investors that are sort of locally based in New York? Some people are looking into that because in order to get all your trades done and cleared on a single day, when we move to T+1 settlement, and Canada and Mexico are also moving the same day, it's going to be a little bit tricky if you're trying to do that from an overseas account perspective. So you may see that.
I've never thought about that.
Yeah,
what's the driver with that?
So you've got to finish the trade and affirm it by 9 p.m. It's the middle of the night.
What's the driver of that? Just to reduce the risk in the system by having a shorter settlement?
Yeah. A lot of it's driven by it came on the back of some of the meme stock issues, and when people couldn't sell certain securities or get out of their positions. A lot of brokers, in the days in between when a trade occurs and the trade settles, brokers, if a name has moved a lot, brokers may have to put up additional capital at the clearing corporation,
Right.
BTCC. And we did have some of those. There were some issues where brokers didn't have the capital. Some of the retail brokers didn't have the capital to put up on days where names were moving, multiple X's
right.
In the middle of the meme stock. And so the idea was that by shortening the time period between trade and settlement, you reduce some of that risk around having to put up capital and some of the issues that occurred. But it's tricky. I don't know. That was definitely actually
one of my favorite
trading patterns.
One of the favorite stories that I have, it's even before my time and that I've read about, is during the 1987 crash when it used to be T+5. And so the Chicago guys were doing the index arb and they were buying futures and selling stocks. And the trouble is, on the first day they did it, they bought the future and sold the stock. And yet what happens is that the future marks to market every day, but the stock they didn't get for 5 days. So there was this huge problem with, the kind of cash flows not meeting up, and almost the system almost collapsed there.
And that's going to happen now. I mean, you think about it, a lot of European funds settle. I think Peter raised an issue with Canadian funds and their settlement. The fund actually settles on a different date than now the securities. So, and then you've got a mismatch in settlement dates. So you sell a European equity and buy a US one, you actually don't have cash for one day. So there's some mismatches. So you go into the first global rebalance, and obviously there's going to be tricky issues in terms of the non-consistent, the inconsistent settlement dates on all the different securities.
So Kevin, let me just throw in there as well. How few people in this business actually understand the plumbing. And Jenny refers back to the meme stock era. And it was really Robinhood that ran into a capital problem. And it was really, I think, the stimulus for moving to T+1 in the US and here in Canada. But I can't believe I'm about to say this, but now twice in the last few months, there have been Bloomberg stories about hedge funds that aren't settling stock trades. And those stock trades end up going back to the executing brokers, and they end up owning them and having to unwind them and end up with potentially losses. And there was a story, I think, yesterday about Mizuho had a $110 million loss, or there was a loss involving a hedge fund that was shorting a stock a U.S. stock, Supermicro, which has obviously been a big name that's gone higher. And they couldn't find the traders for a few days, and the stock hadn't settled. And next thing you know, those go back to, I think it was Nomura and Mizuho combined lost over $100 million, according to the Bloomberg story. And it comes down to the fact they didn't settle the trades. And so what happens? It goes back to the broker, and the broker has to settle them, take the losses potentially, and eat them. And in some cases, they may not have the capital to do so. So I think it was surprising that these simple plumbing things that we've thought have worked forever, every once in a while just break down, and then people can't understand how it possibly happens. But it is important to understand the process from trade to settlement. And the shorter it is, the less risk there is.
Wow, I didn't know that story. I'm looking it up. I pulled it up right now. You're absolutely right. I'm going to dig into that after this done. Jenny, you mentioned the meme stocks. What is something that, from a market structure point of view, you understood that you felt like the rest of the marketplace got wrong or didn't understand? During that period,
so
like there must have been a lot of things you were just kind of shaking your head at, and just what
I can't even bring myself to watch the movie and everything. No, it's it's really tricky. I think, I always get really upset when I think there's news that comes out that people feel like they're getting screwed in the market, or that they're, that the market doesn't work for them. And certainly there were things that broke down in the market around meme stocks. However, as Peter sort of alluded to, it was largely isolated to a subset of stocks and a subset of firms. And I felt this way sort of after the financial crisis as well, where when retail investors lose confidence in the market, or there's this perception that they can't beat the professionals at the market, and that it's like us versus them, that's when you see people exit the market. And that's why I'm not totally against the 24-hour thing, because I think a robust retail participation in our market is what makes US, Canada, some of the strongest markets in the world. And that when people feel I guess I was really disappointed coming out of that people felt like it was us versus them. It's the little guys versus Wall Street. You need everybody participating in the market to have a robust and a working market. And I think that was the tricky part about that. And that was what was really disappointing, because once people leave the market, we've sort of seen this, people have moved away from single stocks and are moving more into options. That's sort of the place now where people perceive that they can get the most return as individual investors. And that's a bummer, because I think, I assume you've been doing this for years. I assume that, you love it. You love trading, and you want to see other people doing it and having a good experience as well.
Yeah, it is frustrating, especially when they end up kind of believing some of this crap like AMC, the apes, and you just know that in the long run they're going to lose, and they're just going to be equally as bitter that they got, taken down this road, and then they're going to be mad at everyone, and so they'll just leave the markets entirely. So completely agree. Okay, I got one question each for both of you. I'm going to start with Peter. I'm going to give you a Canadian one. The government's musing that Canadian pensions should own more Canadian assets. How do you feel about that?
Well, I think it's an evolution that we've seen over time, and I hate to keep going back to when earlier times in our career a long time ago, but Kevin, you'll recall in 2005, our federal government got rid of the foreign ownership limits, which existed for non-taxable entities or the pension funds in Canada. And that really was a seminal moment in the development of the professional pension fund community in Canada, which a lot of people refer to as the Maple Eight. These are 8 of the most sophisticated investors in the world. And even before that, those funds were actually using other instruments to be able to get around that 30% foreign content limit. But it really did sort of pave the way for those funds to become global investors. And over time, as they became way more global, they became way less Canadian, to the point in time where we woke up and all of a sudden those Canadian pension funds that I'm referring to literally owned market weight, which in a global context means Canada is only 3 or 4% of an equity portfolio. And so the government had been, I think, aware of this limited amount of Canadian assets that were being held by those Canadian funds, and started to ask some questions. And And it's concerning to me that we start to think about the potential for interference, political interference in our pension system, because that's a hallmark. The independence and the guardrails that exist between the actual governments and the funds themselves. And I think it's a hallmark of our Canadian pension system. And I really think when people think it's the pension funds that should own more Canadian assets that will help improve Canadian productivity, I think it's a bit misguided notion. At the end of the day, the issues that we face here in Canada, which are, in my mind, are existential, relate to the fact that there's this gravitational pull south of the border for capital, for eyeballs, for new companies, and for that matter, for global companies. And so while the European companies are seeing a domicile change to the US, we're not necessarily seeing that here in Canada. But what we aren't seeing is any new IPOs. So where's the future of the Canadian market 5 or 10 years from now if there aren't going to be any more IPOs, and the majority of those IPOs, when they come, are going to come south of the border? Because we're losing companies slowly but surely in Canada. Good companies that are being taken private are going into the hands of global companies. And I worry about the future of our market. I think that's the issue we need to think about. What's the future of Canada's capital markets? And it's not the duty by any means for the Canadian pension funds to have to support Canadian equities beyond what they believe to be the best investments for their portfolio. And certainly there have been a lot of institutional and issuers in Canada that were supportive of the government's view that Canadian pension funds should own more Canadian assets. But at the end of the day, I don't think we want to get into a situation where we're forcing investments on those funds that have done a great job being unencumbered, because it will potentially come back to bite us in the form of lower returns for those funds. That's certainly something I hope doesn't happen. And I'll just finish on a good note there. I was very pleased to see that at the most recent federal budget in Canada, that rather than the government coming out and suggesting that Canadian funds need to own more Canadian assets, instead what they did is they appointed former Bank of Canada Governor Stephen Poloz to work with the pensions on ways in which they can work more in Canada. And I think that's an excellent development. And I'm certain that this process, as we talk more about it, will morph away from being about Canadian pension funds owning more Canadian assets and onto the topic which is more important, which I think is the future of Canada's capital markets, something that I've been spending a lot of time on.
Well done, Peter. All right, for you, Jenny, I'm going to leave you with something more broad. I'm going to say, what does the future of global capital markets look like in 5-10 years? And specifically, how does market structure evolve in the coming years?
Yeah, I think it's going to be more global in nature, more automated. I think that's going to continue. You see a lot of markets that, like US and Canada, are fully automated. You see a lot of markets that aren't necessarily as automated. So algorithms picking up more in APAC and other regions. So yeah, I think that the move towards more automation is just going to continue to trek forward. But I also think I'm really excited about the evolution of generative AI, the ability to be more efficient in how we cover stocks, how we look at what's going on in the market, all the different signals that we're looking at. Not necessarily like, I don't think it's going to take jobs away, but I think each of us sitting on a trading desk being way more efficient at the information that we're able to take in and how we're able to react to that. That's incredibly exciting.
Well, I did not expect that. Although are there any jobs left to take away? Because I was laughing. I didn't say this, but I remember someone giving me the stat that at one point Goldman Sachs had 200 sales agency traders in the late 90s, and kind of by the late aughts, it was down to 2, with the rest of them being computer programmers. Is that something you
definitely? Hey, the skill set has changed, right? Like there's a lot more programmers. You're hiring a lot more people out of school that are doing computer science, certainly. But I also think we got pretty lean on the street, and then we went into 2020 and all of a sudden volumes were through the roof. And, there was a real challenge in terms of workflow and what people could do and how they could react. So I think we've gotten really, really lean. I don't see us I think it's more about being able to do your job better, take in more information, and being able, like, think about if you could be seeing like all the different things you have to hit, a name's moving and you've got to go to like 3 different people and ask, why is this moving? And try to pull up the news and pull up a chart. And, at that point, the move has already happened. If you could be more efficient about doing that and capturing some of those dislocations, I think that would lead to better results for investors.
That's great.
And I can just add there, Kevin, that at the end of the day, We won't all be replaced by computers, because at the end of the day, we still do have relationships on both ends of either the computers or phones. And it is still a relationship business. Jenny and I do spend a lot of time talking to the buy side. They still do see a value, I think, in their sell side relationships. And the information that is parsed for them in the fashion that they want it. So I do truly believe there still is a role for the relationship in this business going forward. I certainly hope that's the case when we look back 10 or 20 years from now. And Kevin, can I just add, by the way?
Yeah.
Sure. I was wrong on Apollo. S&P just announced that they're moving a mid-cap name from the mid-cap index into the 500 to replace Pioneer, a stock by the name of Vistra, which is a symbol VST. So for your listeners who are popping onto this, that's breaking news.
And Vistra, what sector is it in? Let's just have a look here. It's an energy company. Oh, it's a utility. Oh, that's interesting. Oh, this is the stock that's run because of the AI demands for the power.
Oh, yeah. It's amazing when you think about I'm actually doing a podcast myself on Monday with our telecommunications analysts, and they're talking about some of these fiber optic companies. That was one of the topics. And all of a sudden, there's demand for fiber optics due to all the data centers that are being brought in and used for this whole purpose of AI. So it's amazing how many different sectors have had that word AI thrown in there. It reminds me of the .com era. Remember, Kevin, those days when companies would change the nature of their business and put .com on there, and all of a sudden the stock could go up 50%. So I'm not saying that's the case here, but we do see a lot of people talking about AI in terms of the context of how it impacts the markets.
You're not saying that, but I will. All right. So we'll end it with this question that I like to ask. And it's Patrick O'Shaughnessy often asks this guest, what was the kindest thing someone has done for you to help you along with your career? Such a great question. I'm going to actually steal it from Patrick. We'll start with you, Jenny. Do you have a particular person or event that stands out for you?
Yeah, I think I had like 2 or 3 clients when you sort of build these relationships, and it goes back to Peter's point on like, it's still a relationship business. 3 or 4 clients that when I was looking to make a move, they were like, go to Cowen. That's a great role. We can trade with you. They showed up, they traded, they turned on, they connected to us day one. And like, you always build these relationships, and then you wonder when you go and you sort of make an ask, whether they'll back you up. And it's the people who have sort of been beside me throughout my career, and they've been phenomenal. So, and that's how I ended up at TD when they bought Cowen. So very, very, it was the best move I could have made.
Well, that's great. And Peter, do you have one for us?
I do. Goes back to the credit crisis, actually. And it was one of those times when I was feeling pretty down about the business, down about my lot in life, and down about the future of what I was in. And my wife knew how upset I was. So she contacted one of my longtime friends who lived outside the city but was in the business. Little to my knowledge, I didn't know this had happened, and told him that I wasn't feeling very well. And so I was at work one day, and the phone rang, and it was my friend who had called me up and had asked me how I was doing. And he said he was downstairs. Let's have a coffee. So I went downstairs, met up with him, and he asked me how I was doing. And he was a bit of a therapy session for me, and he was very kind. And little did I know that he had driven all the way into Toronto to see me that day to make me feel better, knowing that I was a bit down in the dumps. So I think about that a lot, because that person, who was actually a mentor of mine in this business, was kind enough to take the time out of their day at the middle of the credit crisis to drive into Toronto and just unannounced to say, hey, let's have a coffee. I'll never forget that. That was something that meant a lot to me.
Oh, that's a great story. All right. Before we leave, Patrick, I keep calling you Patrick, my partner. It's too close to, it's too many P's for me, Peter. You have a podcast, and why don't you tell people about it? Let's start with that, where they can find out more about market structure and all sorts of great stuff like that.
Yes, I do have a podcast. It's called Bid Out, and it's available on all the popular platforms. And I finally had Jenny as a guest on to talk about algos a few episodes ago. And so, yeah, we just try to find things that are relevant anywhere in the world in terms of market structure, and just kind of try and cover the topics of the day. And I think we're on to something like episode 57 or 58. We kind of do them every month. And I also am fortunate enough, I work with Frank McKenna, the Honorable Frank McKenna, who was the Premier of New Brunswick. For those Canadians on the line know who Frank is. And he was also the ambassador to Washington. And about 5 years ago, I went into his office and said, would you mind doing a podcast with me? And next thing you know, here we are 5 years later. We've done a monthly podcast on geopolitics. And I learned so much from Frank, and now my new colleague, Chris Kruger, who's part of the Cowen team, Washington Research Group team, who's been on the podcast as well, and speaks about all the micro stuff in Washington, and learned so much from them. I know Jenny and I spend a lot of time with Kruger and some of the other folks, and it's interesting. There seems to be a common interest for people that are interested and curious about market structure. They also tend to be the people that are curious about developments in Washington and the financial services rules and the like. So we get a lot of mileage out of that. But I do have those 2 podcast series and really enjoy it. And by the way, Kevin, I got to give you a thumbs up. You do a phenomenal job as a host here, being able to bob and weave with your questions back and forth. It's a skill, and it's taken a long time for me to try and figure that one out. So congratulations on the pod that you have.
Thank you very much. And for those institutional clients on the line that are interested, make sure you reach out. You get Peter's unbelievable index report. As I say, it's been running for way too many years, and it's a must read, and it's something that everyone should be. If you trade with them, you should be sorry. If you don't trade with them, you should be trading with them, because you should be going and getting this research. That's on the Canadian side. Now, Jenny, for you, you're obviously an institutional trader. And if people are interested in learning more about what your services at TD Cowen that you offer, how should they reach out? Should they grab you on Bloomberg?
Yep, I'm on Bloomberg, or my email. I'm also on Twitter.
Oh, you're a brave soul.
Occasionally tweet on market structure stuff. Okay,
well, you got to tell us if you're going to name the Twitter, you got to give us your handle.
Oh my gosh, I don't even know. I think it's like Hadiaris Cowen or something. There's not many Hadiarises out there, though. I promise you, if you look that up, you can find
All right. So if you're interested in learning more about algos and all that sort of stuff, make sure you reach out to Jenny or Peter. A big thank you for you both to being on the show. I really appreciate your time, and have a great weekend.
Yeah. Thanks a lot, Kevin.
Thank you, Kevin.
All right, Patrick, it's time for Talking Charts. What do you have for us this week?
Well, listen, we haven't done this for last 2 weeks ago.
Oh, yeah,
so
you were busy turning 50. How was that?
It was awesome. We'll talk about it in the post game or afterwards at the end of the show. But listen, let's just skip right to the top 3 things that we're watching in the coming 2 weeks. And I think one of the really interesting things to watch here is what's going on in the commodity markets. And so I wanted to just quickly touch on. First of all, we saw the really big move in cocoa futures. And that was crazy. We'll pull up a chart of that shortly. But now we've gotten these pullbacks in both oil and gold, and both of them have been in bull trends. And both of them, the question is this just a big buy on dip? And we'll go through all the commodities here very shortly, but I think it's definitely the top thing to watch in the next 2 weeks, whether they establish trading lows after this retracement. Do you have a comment on that, or you want me to go on?
No, I think it is something to watch, and it shall be interesting to see if they manage to just bounce from here, and this is just a little bit of a decline. Kind of worries me, because the best markets don't give you a chance to buy. So the fact that this is giving you a chance to buy is worrisome.
All right. So number 2 is the short-term top in yields in. And it's very early. Like, we have only seen a couple hours of trading since the turn on the jobs numbers on these yields. And that's too little information as to whether there's a meaningful turn. But we've had very oversold bonds. And I know that there's some inflation fears and things like this trickling in, but at some point this oversold market was going to retrace and have a reflexive rally. The question is, was this enough news to create a counter trend rally?
I do have an opinion about this. No way that the short end is going to go up in price, down in yield, because I actually bought it. All right, what's number
there
one?
You go. Number 1 is the inflation numbers coming out. It's not next week, but the week after. But obviously, this has been one of the things that's been driving markets for the last couple of months, because the uptick in inflation has certainly put pressure on yields and caused a lot of nervousness. And so, will that trend continue this month is certainly the thing to watch.
I would agree with you there, Patrick. And I just want to remind people, we've actually had 3 months in a row where it's come in hotter than expected. It would be surprising to me if we have a 4th. One, because as you have 3 in a row, people change their expectations. And it used to be that you'd suggest there would be higher yields or higher inflation. You got told you were insane. Now all I hear, Patrick, is everyone telling me how the U.S. economy is so strong. There's no way you can stop it. There's no way inflation's going to go the other way. So when everyone's zigging, you should be zagging.
Well, there you go. All right, so let's get to the charts. I want to talk about a whole bunch of these commodity charts, but let's start off with the S&P. So let's first of all, the jobs numbers came out, and it's the kind of first disappoint that we've seen this year. Like all the prior jobs numbers were more or less in line.
Call it a disappointment.
Well, it was below expectations.
I guess you're right that the actual economic number is disappointed. But having said that, I almost think the Fed and the markets were hoping for a lower number, right? They want to see some weakness in the jobs market. The last thing they wanted was a job market that was continuing to be too tight. So the fact that the job market is loosening up and we're actually seeing some less strength, I think markets have correctly taken
my only problem with that is I don't think that when the jobs numbers uptick that it's just going to be a little bit of weakness. I think that if this becomes a trend, after
you mean
this
the
kind of
list, like the unemployment uptick.
Yeah. When unemployment upticks like this, if this is actually a persistent trend, in the past, when we've had increases in unemployment rates, it was when the economy was already in a recession. And I'm not saying that that's the case, but I don't think it's a good thing if we start seeing labor weakness, because that really means that the economy is actually not as remotely as strong as everyone's making it out to be. And this is why, obviously 1 month print is not enough to draw any conclusions, nor am I trying to make that market call. But I don't think it's a good thing.
Well, I would agree with you in this manner, Patrick. If we had continued weakness in the jobs market, the stock market or the financial markets will eventually worry that what you're saying is correct and that we do have the onset of a recession. So whether it actually occurs or not won't matter, because the market will become scared and might price it in. Or start to price in the higher possibility of that occurring.
All right, so let's talk about the market reaction to it. Clearly, the first thing was the yields broke down. This is the 10-year yield, making that downwards move, and there was obviously also weakness in the dollar, which to some degree or another is already rebounding on there. But we basically had a weak dollar and strong bonds. And that initially impulsed the S&P 500 higher. And at the time of recording, we were up 60 points. But I'm not convinced that this is as bullish for the market as everyone makes it. This is just the first intermarket impulse that in response to it. But I still am increasingly in the camp that we are witnessing some much more defined topping formation establishing itself. And whether that involves a head and shoulders and the market still breaks slightly to a higher high, prairie dogging that previous high, or whether it just fails here around 5,200, I think more or less the first, this 5-6 month bull run that was underway up until April, really, I think defined the bull impulse for the year. And I think the stock markets will be very heavy up here and rallies will start to be sold. Whether it turns into something far more ominous on the downside is, I don't think, necessary to try to predict right now. But I think that there'll be very muted rallies that will quickly fade.
I can't disagree with that. So, folks know what to do.
Yeah.
Buy the shit out of the market. Yeah.
The interesting thing from a short-term pivot perspective is will this bull breakout today that's attempting to close above its 50-day moving average, will it be able to clear 5,200?
So wait, are we at the 50? We're recording this at lunch, by the way, for the folks. Yeah. It's almost 1:00. Are we right at the 50-day, like right now?
No, we're well above it. Like the 50-day moving average is
was that the open
51.14 on the June futures contract, and right now we're trading at 51.49. So we're a solid 40 points above the 50-day at the time we're recording this. But I don't think close above or below the 50-day should be put an overemphasis on, because it's really about sustained trend above a moving average. There's plenty of cases like let's go reverse back here to look at August of last year, right? And after the first wave of selling occurred in July going into early August, the market spent 2 weeks trading above the 50-day moving average, and it still didn't stop a sell cycle from playing out. The point is that you don't want to put over importance on just whether you're pivoting above or below a moving average. What's much more important to me is whether or not these rallies are sold. Like if we see that this can't follow through to 5,200 and we find ourselves back below 5,100 a week from now, then it's just demonstrating that there's active distribution into all strength. And that should be concerning, that there'll be at least another leg lower in the correction.
I like that analysis, Patrick.
Okay, so let's move on to the dollar. The dip came, what I would argue is all the previous highs act as support right at a 50-day moving average. This 104.50 level, 104, 105 level was sort of where a typical pullback would occur. And if you look at that euro yen, that is actually, I think, the currency to watch when trying to anticipate where the next move on the Dixie is. If this,
you mean the euro dollar?
Yeah, the euro USD. Sorry, I meant to say.
No problem.
And so the key here is that will we see today's uptick be faded? Because if we see that the euro USD ends up below 107 by early next week, then this thing still has a trip down to 105 in store. And so whether or not they follow through is really important on an uptick day like this. But let's talk about where this one rock star bought the yen.
But wait, I thought I was a bum last time. I still am a bum.
Well,
it's still offside.
Dude,
my purchases are offside.
It's still offside.
Although at least I was smart enough to add to it like an idiot.
Yeah, like an idiot. Yeah. So like dollar cost average your losses. Like Gartman and Jesse Livermore are basically shaking their heads at you right now. Like
one of the things I did do, Patrick, I was actually surprised when it started to accelerate, like the selling of the yen, the rally in the USD JPY really accelerated. I was shocked that vol didn't go up as much as I would have expected, given the risks out there. So actually, I did something you'd be proud of.
It's incredible. What did you do? You
went
long gamma?
Yes, I went long gamma, and I was like, why are they giving me this? Like, I thought it was strange. Like, the vol is through the roof. You'd think that they would be reaching for this, and they weren't. So I actually did.
I mean, that's a 700 pip swing.
Yeah, and I took the opportunity to add to it because I was like, okay, I can actually, limit it. I think the vol's going up. Even if it kept going, I felt like it was a good trade because vol would rise. So I don't know. It seemed strangely weird to me that it didn't spike more than it did.
Well, the one interesting thing, irrespective of whether there's an intervention or not going on in the yen.
Well, no, there is.
The point I want to make is that literally every single cross currency has now, in the last week, pretty much like 50% retraced its prior U.S. dollar strength. And from a typical market price action perspective, this is a typical length of a correction for where if buy on dip traders were going to buy the dip, it should happen at these levels.
You mean buy the USD?
Yes, buy the US dollar dip. So fade the euro and so on, depending on obviously which one's the cross currency on the pairing. But basically, if the US dollar is still in a primary bull market, these levels should hold where the dollar is.
Well, we'll see.
And so we'll
I think we're going to get more intervention. I don't think that's it. I think that there's going to be a lot more excitement to come in this.
Well, intervention is one thing, Kev, but I think the bigger question is the intervention defending a level, or is the intervention trying to directly take the currency to another target? Okay, right? So if Patrick, they're basically saying that we're going to defend 160, well, that's one thing.
No, they're not. They're not defending a level. It's not like that. They're trying to move it. I'll tell you one thing, Patrick. I couldn't tell you after the first intervention, how many folks came to me and said, look at this. The intervention wasn't enough. They're screwed. It's headed to 180. It's headed to 200. I was like the emperor, like, let the hate flow through you. Like it was just like awesome. Like the amount of skepticism I
says the guy that's been dollar cost averaging and is still offside on his trade. No. Like you're talking like
no, but I just thought it was finally my signal, and that is ultimately why I did increase it, because it was like that point of maximum skepticism where people were so sure that there was no way it was going to work. There was like Twitter spaces of like, the big quote unquote FinTwit stars about why the yen is in a box and stuff like that. It was just prevalent, and it was everywhere.
Yeah.
And it was just kind of it felt to me so much like term premium, bro, back in late October, when I was getting lectured about, term premium from folks who didn't even understand the difference between term premium and, like yield curve. And yet they were so bearish. We had like that one fellow that was talking about the QRA, getting everyone in a huge kerfuffle about this QRA. And then ultimately the QRA was basically right in line where everyone, in terms of the serious bond houses, were expecting it. And he quickly covered. He was at least shrewd enough to figure out that it wasn't what he was telling everyone it was, and then everyone blames it on the QRA. And I was like, no, well, the reality was you guys got everyone so bared up on bonds that you created this, and then at least you had the good sense to cover it, but the reality was it wasn't the QRA that drove that. And Patrick, like, I think this last QRA is a perfect example. We've gone from the QRA being what everyone on FinTwit was talking about. What happened the last QRA this week? Nothing, nada. It wasn't an event. So I actually feel like this yen is the same thing as the QRA. It's the same thing as what we experienced with the bond.
I'll make my call. I think that you're gonna still feel a little bit of pain before this thing is a big winner for you.
I would not disagree, be shocked, Patrick. But listen,
I'm not going to be shocked if this thing goes like this and turns around. So for those who are just listening, levels.
Patrick's just drawn a picture up to 165 or 170. Okay.
No, what do you mean 160?
No. Is it?
Can you look at it?
Okay, I can't see
160.
it. You're talking to an old man with terrible eyes.
Yeah, no. Okay. 160. All we're talking about is I think there's a very reasonable chance that that we're going to go and double top retest that high, and it's going to make you a little bit nervous about your position before you end up being right. And I actually think that at some point, definitely at some point over the next 2 years, but whether it starts in the next few months, there will inevitably be a substantial US dollar decline cycle. I just think that it's much farther out, and I would not be surprised if this trade muddles until we have a more pronounced US dollar bear market against all cross currencies. I know that you like to play these independent storylines.
You've been hanging out with the FinTwit Japan is screwed and is in a box. You shouldn't even put 160. You should put like a real target there. You should do 180, 200.
Oh, come on,
they're
stop
going to go bankrupt.
What's wrong with it just going to retest the price it was trading at last week? You're being silly. Let's talk Bitcoin if we want to be silly. But what I wanted to just talk about the asset that shall not be named is that it's now 50% retraced after it being basically in a 2-month kind of topping formation and decline. And this 50% retrace is actually an important tell. If this is a level where if Bitcoin bulls are going to keep this thing going, they're not going to let it go any lower. If this thing breaks the lows from midweek this week, this thing could go all the way to 40,000 again. And so this is I consider this to be a very important make it or break it moment as to whether or not the dip gets bought, and they need to pretty much clear 66,000 again in order to really turn this trend back to the upside. So it'll be a curious thing to see whether they can pull it off. I'm obviously a no coiner, so I'm not going to be in it, but it'll be interesting to see technically if that plays out that way. No comment, right? Okay, so let's move on, Kev.
I'm still confused why we're talking about all these charts in dollars and not Bitcoins, and we're not putting everything in spreads versus Bitcoins.
Fair enough. Okay, so let's. I'm not going to comment on anything because we're just going to get ourselves in trouble. Let's move on to gold, and you know what, Kev, like a lot of people are saying that, like you were commenting that this kind of a pullback shouldn't give people an opportunity to get in on a dip type of thing. But I don't look at it the same way as you do. We didn't even remotely approach a 50% retracement, which is down at 2,200. The way I look at this is that this rally inevitably was going to get checked. And now we're in some sort of a consolidation that's still well above a 50-day moving average. It still fits all of the criteria of like a flag or wedging formation that can easily bullishly turn up. And so the one thing that we were talking about as top 3 things to watch is definitely whether or not these commodities get bought on dip here. And this is a very logical place, let's say next $50 in gold, to see whether or not the bulls can defend the line and put in a swing low. Obviously, it will take this thing turning back up north of 2350 to turn the chart back up higher. But this is the type of a pullback that'll be interesting to see whether it gets bought on dip.
So here's what I'm going to say about this. If you go look at the yen versus the gold, the correlation is completely flipped, meaning that a weaker yen actually resulted in a stronger gold price, which was traditionally the opposite of what you experience. Usually when you got a stronger USD, gold went down. So now we have a situation, and the reason that occurred was because, like a lot of these Asian investors were, experiencing a currency that was devaluing. They can't earn any yield, and they were like, okay, I'm going to buy some gold. I ultimately think that the central banks are the ones that really created the bull market, but over the short run, there's no doubt that it was accelerated by the Asian individual investor buying gold. So now, I actually think if you're correct about your yen call, that we have a situation where it goes back to 160, meaning we get yen weakness again, that would lend credence to your call that gold would go back up. And this will be the end of it. But what I worry about is if we actually go into a sustained yen bull market, and I know you're like way too early. We're just at the back of the moving average.
It will happen inevitably, though.
Okay, but you're too early. You're like, I'm too early. That's what you're claiming. And I listen. Could be. I get things wrong all the time. So this wouldn't be the first time. And it certainly won't be the last. So if that was to happen, though, if we did get a yen bull market, what do Asian investors that had been the driving force of this last leg of the gold bull market do with their gold? Like, I think it's a good question. It's like, I don't have the answer, but I don't think it's I don't think you can say, oh, a US dollar weakness is going to, automatically create gold bull market, because let's face it, we've had gold going up in the face of higher rates, in the face of a higher USD. And what if both of those things flip, and then gold, when everyone's expecting it to be bullish, actually does the opposite. And that is what I worry about.
From a cycle perspective of where we are economically, gold tends to do the best, when there's a substantial weakness in the dollar and monetary policy. Monetary policy is easing.
It tends to do the worst when the opposite happens, and yet it just did the best during the point when it should have done the worst.
But the point I wanted to simply make, though, is that, let's just go through a scenario, which I don't know if it is going to play out, but let's just say we have some form of an economic slowdown recession that manifests itself in the second half of the year. And
that's
inevitably,
way too long for me, though, Patrick, like I'm talking about the next month.
Okay. Well, point I want to make is that during a period like this, where ultimately you could have pressure on risk assets, there's no reason why gold can't go through an entire downturn cycle and go through a deep mean reversion of this entire pullback, and then subsequently have its major cyclical bull market once the easing cycle and dollar weakness prevails. So the thing is that we're trying to split hairs as to whether there's very short-term weakness coming in on gold. I still think that even irrespective, gold will have to put in some sort of a topping formation. I don't think there's enough. Now, if gold rallied back to its previous highs, failed to show follow through, loss of momentum, all sorts of different indicators, well, then I would be much more near camp that there could be a deeper, more sustained pullback. But right now, I'm buying the dip.
Okay, I'm not disagreeing. I'm unsure. I want to buy the dip. I want to be bullish gold. I am worried.
Well, then don't do it, because then you're going to Gucci it for me. Just keep being skeptical based on your yen thesis.
I'm always long gold, so it's just a question of degree.
All right, let's talk about crude oil, though. I also think this is a buy on dip, and right here at this level. I think that at some point we were going to give back half of the gain. Everyone was all worried about this geopolitical escalation, and the weak hands have to be shaken out of the trade. But I don't see a scenario where oil's going back down to 70 unless we're going into a global economic depression. And therefore, this type of a pullback, I think, is an opportunity to see oil trade right back into the 80s. And so I'm buying the dip here.
I'm not going to disagree. I'm a long-term bull on oil. I think it's dirt cheap.
All right. So the other thing I wanted to just talk about before we get to the cocoa chart, looks like these, I'm going to even put on a weekly chart just so that we can really zoom out. It feels like the grains might be done selling. Now, when I say done selling, because I don't want to already call a new bull phase, but it's been an awful 2-year bear market in wheat. And we're seeing that it's found the lower boundary of its support lines. And for the first time, we're seeing these things upticking. And whether it's wheat, whether you look at the chart off of a very oversold corn, or you look at the selling subsiding in soybean, I'm curious whether short-term lows start establishing themselves here. And that doesn't make it immediately bullish. We might end up being down at these levels for many months more. But is the selling over is one of the kind of puzzle pieces I'm trying to solve there.
I think that's a great observation. You know, a couple of friends of the show are Rupert Mitchell, AKA the blind macro squirrel or whatever it is, blind squirrel, macro. He's been bullish. Paulo Macro has been bullish as well on these things. I'm tempted. Like, I really am. And now that you're no longer like bearish, and like I get it.
I was I was not bearish
but you were
at any
saying
point.
It's
I
in
was
a downtrend, and you were saying that there's no point in trying to catch this knife yet. And now you're saying if you think about it, at least you can. Catching the knife here isn't as stupid as it used to be. Is what you're basically saying. Is that correct?
Yeah. Well, the price action is diverging from being in a distribution cycle to more that it's now found the lower boundary of its support, and that these are the price levels where you might think. But the interesting thing is you're simply not seeing any love being given to those ag stocks yet. Like they're left for dead. There's not a pulse on that.
But you know what I would say about that? Is that just like gold rallied, and it took a long time before the stocks actually started to behave differently. So I think it would be the
I agree.
Yeah.
Look, if the ags are turning, inevitably the ag stocks will start to reflect it. The point is that no one seems to care yet.
Yeah.
And that is certainly just an interesting observation to kind of observe on these things. The other thing I want to touch on is uranium. So the U308 finally back above $90, and we're having these little breakout attempts on the Sprott physical. Now, like when you're looking at the one kind of thing that's a little bit interesting of an observation is that the NAV has now jumped actually into a positive over the spot price.
Yeah. So what that means for those who are interested, the ETF has hit a point where they can actually issue ETF and buy uranium. I think that Cuppy calls it ATMing, which is an at the market deal where they issue shares to buy actual physical. And so that's occurring.
Yeah.
So
right, and so the question that's curious here is this sort of like the fund and investors front running what they believe will be the inevitable uptick in spot prices, or is this a false start? I'm very curious as to whether or not, like, look, when uranium in January had that melt up, and it was like trading like it stole something and is running away. Like it's just like been a gorgeous run on the upside. It was inevitable that it was going to go through a correction. And now it's spent 3, almost 4 months backfilling, consolidating that bull run. That meets all the criteria of a typical corrective phase. And it's curious whether or not these are the early signs of another bull advance.
Well, that's basically Cuppy's point. And Cuppy's always been saying this, throughout this entire move. He says, yeah, you can trade it, try to catch, 5% squiggles or whatever. The danger is that you'll miss it when it takes off again, that the surprises will be to the upside. By the way, Patrick, part of the reason it's doing so well, there's some sort of Russia, the U.S. is doing something with the Russian and the uranium folks.
Investors investors are playing the fact that Russian sanctions are a theme that's not going away, and Russia supplies a very large amount of uranium, and this is going to be something that is going to be an overhang, a bullish overhang on these markets. The likelihood that that there's suddenly going to be peace and the Russian markets freely open up again, it'll take years for things to stabilize like that again.
That won't. Yeah,
that's what I'm saying. Or if it does, it's going to take years. It's not. Yeah. It's nothing that's like a light switch going to turn tomorrow.
The other thing is, I think that the whole theme about the fact that we need way more electricity is finally kicking in, and people are realizing that this is a solution to the problem, right?
Yeah.
Yep. The other question is: Are you going to talk about the natty gas? Are we done on uranium? Can we go to natty gas?
Because let's go to nat gas.
Because if you believe that the electricity problem is going to drive the uranium bull market, you also have to start to think about whether, in terms of the short term solutions, the natural gas in terms of creating power plants has got to be something we look at as well. Is this finally the point where you can buy some nat gas?
You know what though, Kev? Like when you go out the term structure, I mean, winter gas is already $3+. Like
I know,
this is a short-term supply thing, I agree with you, but I don't think.
Let's look at winter gas and see what it used to be. So you're saying it's $3 now, but I'm saying that what was it before? Because it's down a lot. Even from
so, what do you want to look at the Jan contract?
Yeah, or whatever. I'm looking at December, Christmas. Let's see. It's 3.5, but it was 4.5. Last year.
Yeah, well, this is what I'm pulling. So you can see here that like this is the Jan contract, and you can see the January 2025 traded at 460 and 5. Yeah. And so that could easily be a 50% rise in winter gas if this is a turn point. Yeah. I get it.
Nobody likes it. Nobody likes it, and you're just viewed as like a complete lunatic.
It's been stereotyped as the widowmaker, so most people generally are scared to touch it.
Yeah, well, I don't know. To me, it feels like you should finally start looking at these things.
You shouldn't. If you do put it in, you got to be careful with your leverage.
The other thing is don't sell volatility short.
And then on naked calls.
Yeah. What is it? What is that?
3x leverage.
Pal there?
Optionseller.com.
Optionsellers.com. Yeah. And listen, when you do blow up the account and you're telling your investors, take off the $40,000 Rolex ahead of time.
Yeah. Don't videotape.
Pro tip from the huddle.
quick look at platinum and palladium.
Okay.
They're precious metals that have just not moved yet. But this has now been a 1-year support line established on platinum. And when you look at palladium, it's been in an awful bear market where the thing has wiped out 75% of its value in 2 years. It's still not a nice chart. It's still ugly. But you have to think at some point the bloodletting has got to come to an end on this thing.
You got to wait for me to get long for me to feel some real pain, and then you can buy it.
Yeah. Well, you know what? I would think that at least it would have got an uptick on all the attention precious metals are getting, and nothing. Well, this thing is almost at its February low.
So I'll push back on this, and I'll actually explain to you this within my thesis. I actually don't think that anyone really likes gold. Like lately, yes, of course, with the geopolitics, there's been some people that are changing it.
But I love it, Kev.
But I love it. No, let's rewind. Let's rewind 3 to 6 months ago. Even though it was going up, everyone still hated it. And the reality was they were focused on that idea about the US dollar and rates. And they were like, you can't buy gold. These two are going to crush it. And I kept saying, no, you're missing the bigger picture. The bigger picture is the central banks are buying it because of the reality of the sanctions on the Russian central bank. And it basically makes it so that if you're the People's Bank of China, you have to buy gold. It's just the only prudent thing to do. So if you think about it in that context, Patrick, it makes sense that these other ones aren't moving. If that's what drove the price of gold, if it was central bank buying, they're not going to go and say, oh, you know what? Gold's gone up a lot. I'm going to buy palladium instead. It's not happening. So I think that really this is showing you what gold would have traded like had it not been for the Western sanctions on Russia.
Right. Okay, so let's move on. I want to touch on cocoa.
So I don't know the story.
No, but you know what's amazing?
So this Pierre, what's his name? Pierre Arderon?
Yeah, the oil guy. That's
the oil
suddenly...
guy. Yeah, didn't he nail this thing? And isn't the question?
Well, you know what? Ever since the Jesse Livermore times, there's a huge thing about getting your street cred by cornering a commodity. And the question is that how much of this was a properly cornered commodity market that was, that had the right conditions for this kind of a squeeze. But ultimately, when you run something like this, you have to unload it at some point.
Yeah.
Right. And the thing is there's no one on the bid when you've run it like that. And so this is the type of volatility that comes on the other side.
People, if you haven't dialed the cocoa chart, dial it and do like a 20, 30 year chart, because that's the hilarious part. Right? Can you pull that up actually while we speak?
Yeah.
Yeah. Like the move, it looks like Volkswagen when everyone got squeezed.
Yeah.
Question is it an Eiffel Tower formation, Patrick?
Absolutely. Absolutely. Look, no, listen, there are what do you call it? Long-term inflationary trends that will keep commodity prices persistently higher over long periods of time. But this was 100% a market manipulation on the upside, and it's going to mean revert entirely the other way.
Tell us how you really feel, Patrick.
That's how I really feel.
I know. You know what's funny is I know you're not short, but you sound like a bitter short.
No, you know what? To be honest, if it has one failed rally, I might lean into a short. But I'm not going to touch it yet.
Yeah, okay.
No, I'm not touching it yet. But I want to talk about some of the other commodities because sugar has been getting hammered on the downside. What's it called? It's still in a bit of a downtrend. It'll be interesting to see whether sugar puts in lows, near the 17, 18 level. It still looks weak, like it's going to go a little bit lower, but certainly worth watching. Another one to also watch is look at the Eiffel Tower formation on cotton. Like cotton had this bull breakout, ran north of 100. and then just had its feet cut out and right back to the November low within 2 months.
Can I do another one? Lumber.
Yeah. Oh, yeah.
And so all
100%.
these things, like, for those who don't know, I actually bought levered twos a couple of days ago. And I've been huge bull, economic bull, expecting the economy to continue to outperform to the upside. And so this was quite a difference of opinion for me. It was quite a shift. And I'm looking at some of these things, Patrick, and I think there's signs that, like, beneath the surface, we're finally seeing some, like, demand weakness.
Yep. I think so.
Like, I really do. Like I don't want to own the long bonds because I think you guys are insane.
No, the 2 year, like this, that's where Harley Bassman's TUA.
Yeah, the TUA. That's what I wrote.
Yeah,
up.
like what a great product. Let's see whether or not we're right about the market call. But if we're right about the market call, that's a great product to trade it with, right?
Well, it's a great product regardless because it's a tool for you to trade this when you do have that view.
Yeah.
Right. And for those who don't know, it's in essence, it's a levered bet on 2 years. And then he tries to lever it to a point where it equals the duration of a 10-year, but yet it is the kind of payoff profile of the twos.
Yeah, it's a great diversifier for a portfolio because inflation could keep the long bonds all under stress and caught up in knots, and the 2 year is the one that's going to be most responsive to Fed policy. So it's a great way of playing it. I love it.
The part that I think a lot of people, before we go on, a lot of people misunderstood about that thing is they didn't understand when there were 7 cuts built in. That thing was technically not carrying negatively, but it did carry negatively on a levered basis. In essence, what was happening was you were paying for that privilege and it was all built up, baked in. But now with only 1 cut, although that's increased over the last day, with 1 or 2 cuts priced in only, it was a much greater bet. For those who are interested, send me an email, kevin@themacrotourist.com, and I'll send you my piece about it.
All right. The last thing I just wanted to mention, like, I'm just dying for when the liquidity will inevitably show up in these block cheese futures so I can trade them. Like it's this at some point I want to trade this. This is just not liquid enough. But one day I want to be rolling in the block cheese. I'm going to corner the block cheese market.
You should just stick a bit out, get long some cheese. And you know what you should do? We should take delivery.
Absolutely.
Like, how much is it?
Absolutely.
Like, what's the contract? 50 grand, 100 grand? We should make a GoFundMe. We'll go buy.
We'll take delivery on the cheese futures.
Hey, by the way, did you hear about the fraternity group that somehow did something with this flag? And I'm not going to get into the politics of it, but in terms of the actual result of what's happening, it's kind of funny. There's a situation where this fraternity group did something where they didn't let the flag touch the ground, and now everyone's funding them to have a rager. Like, literally, it was like fund our rager was basically the GoFundMe. It started off, the first day was 85 grand. Last I looked, it was up to 360 grand. Like, what are you going to do? Like, what is that rager going to look like? That's like out of control.
That's going to be
and you know who the number one contributor to it was? You're going to laugh. It's a hedge fund guy, Billy Ackman.
That's all.
10 grand. Really? 10 grand for the rager.
just to get your name out there.
Well, I don't know. Listen, anyways, we have no opinion about the politics. Don't send us anything about the politics. We just think the funny is 350,000 for a rager is funny.
And more importantly, that Ackman is the one that was the biggest. Okay. The 10-year bond, even though, you're not going to buy it, we know this. The question is that did this weaker jobs number, a high spike in unemployment, was that enough to put in a short-term low on bonds? That's going to be 100% one of the things I'm going to try.
No.
Short-term, not the long-term below and bottom. There's absolutely a chance the short-term low is in.
0.
No, what do you mean? No, you're so wrong, dude.
Listen, I'm not, like, you're right. It can rally back up. Actually, can you do me a favor? Can you pull up yields? One of my subscribers,
on which
real
one?
Smart guy.
10?
Yeah, 10s. He was pointing out to me, he drew some
trend
lines on this yield. And he's just like, oh, look, it's going to, like, he's like, we kind of pushed up against the yield on the top side. What am I looking at? Where did he draw this yield? Is that the 10-year yield?
Yeah.
I guess he drew it this recent trend line one. Can you draw it from like December or whatever, like that, and then draw? There we go. Yes, that's what he did. Okay, so make it a lower, yeah, and lower and higher. That was it. And he was like, this was a few days ago. He sent me this. He's like, oh, you know what? It wouldn't stop anything from this bouncing to the bottom of that trend line. And actually, he was.
What do you mean? We could see 4% yields again? Absolutely.
I'm going to go with.
Now look,
I'm going to. This is my call. This
save it for Krayons with Kev if you're going to be like this.
It's going to bounce off the lower trend line. The guy that I talked to, listen, he's one of the smartest, guys out there.
Let's find out. He's still using crayons. I don't know how smart that makes him.
That's right. He drew fucking lines on charts. How smart can he be?
Yeah, absolutely. All right. I do like crayons. Okay, I'm done.
All right.
What
time for Krayons with Kev, right?
What do you got, buddy?
So pull up the chart I sent you. XBI. Patrick did say, why is yours more special than mine? Because I drew some nice lines. I think this is a rolling bottom something or other.
Or a cup and handle formation, or whatever you want to. Basically, you're talking about the fact that there's a right shoulder that is made higher highs. That is typically a nice buy on dip, and that would be a bubble that's moving under. So you're basically making a bull call here, eh?
Yes, I love it. I think it's headed higher.
So you know what's my pushback on the XBI versus the IBB?
Okay, well, I don't care. What does that chart look like?
So this is the XBI, right? And look, it's a beautiful 50% retracement, getting back above its 50-day. I mean, it could go. And then you got the IBB, which is had a similar style pullback and a similar style little gap higher. The one thing is that when you step back in the bigger picture and look at where we are in the stock market cycles, my biggest thing is that generally money has not flown into the kind of mid-cap space. So the biggest difference between the XBI and the IBB is the IBB has all of the behemoths, the Amgens, Biogens, all of those kind of names, while the XBI has all the kind of a much larger diversified basket of more average sized biotechs.
Yeah, that's what I want, though. I want the.
But in my opinion, those are the stocks that are getting no flow.
Yeah, I completely
agree. Everyone is chasing, the hottest thing that is working, and they all kind of lump into certain, the hot stocks. It was the Mag 7 before. It's this and that stock now. The thing is that I feel like the time when the XBI will have its most glorious upside run will be a period when small caps will get love too. It's because it's going to be a broader rally.
You know me, I'm perpetually bullish on that. By the way, are you like auditioning for some sort of communist propaganda thing? The glorious upside run. It sounded like.
Anyway, point is, I would if I was looking at the same type of a pattern. This is the weekly chart on a bigger scale. I would be more inclined to be watching for the IBB to break out over that. It's still the same biotechs, but it's just you're going into the much larger cap names, and you're going to be relying more on like the upturn in the stocks like Amgen, which had this huge earnings beat, by the way. Look at that beautiful gap on that stock. And you're like betting on these types of names continuing to run rather than relying on the broad basket to getting a lot of flow. I would rather be in the large caps.
I will take that under advisement.
But the chart pattern, I agree with your chart pattern. So from a Krayons from Kev perspective, I'm not going to shit on your idea.
That's about as good as I get.
That's about as good as it's gonna get. All right, buddy.
All right, that's it for us. All right, thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Give us a follow on Twitter or X or whatever Elon's calling it these days. You know the deal. Patrick, where can they find you, buddy?
They can follow me on Twitter at Patrick Ceresna, or find me at bigpicturetrading.com. And Kev, where can they find you, bud?
They can go to themacrotourist.com and check me out there. Listen, we can never have too many friends. Bull market, bear market. We're just happy to spend some time together on this crazy ride. Now stick around for the after show.
All right, Danny, join us.
What's the beer? Has Danny got one, by the way?
No. But you know what? Me and Danny are gonna collaborate. He's getting his ass to Mexico tomorrow, and we're gonna make sure we pair up some beers for the next 2-3 episodes.
I feel like you guys are a sophisticated bunch. Maybe we should up it to like Scotch for you guys.
Ooh.
I wouldn't say no.
Yeah, you should do something a little more sophisticated since you're getting together in person.
But increased chance that I will be completely plastered halfway through the show.
Of course, but it's always those are the best shows.
I mean, we have had some comments recently that the beer game is a bit.
Stop it! Stop it!
So
it's all about what I care about, and
who
gives a shit about
Daniel
whether they like
comments
it or
not. And then lets it bother him.
Whatever.
He reads the
I
comments.
freaking like drinking beer during the show, so
fuck them.
Screw them.
Yeah, if anyone has any problem with it, they got tuned into the wrong fucking show. All right, rate this beer and then tell us.
Yeah. Listen, I love this freaking beer. I'm giving it 8.4. I'm gonna literally go to the grocery store and buy a couple more. This is actually a great beer. I like it.
Don't lie, Patrick.
I like it.
You're not. No. You're not buying a couple.
I like this beer.
You're buying a couple.
I'm buying
this more. All right.
It's sessionable. I'm gonna buy a 6-pack. No,
6-pack. Patrick, that's your morning breakfast. All right. How was your 50th birthday party?
Oh, it was awesome, bud. And thanks for covering the show. April 19th was actually my birthday day, and I was in no condition to log in to do my part in the show. So thank you for holding the fort.
No problem.
There, but,
I'm sorry I wasn't there.
It was.
I've seen some pictures. You guys looked like it was off the hook.
It was quite the party, bud.
Did anyone get arrested?
Quite the party. No, we didn't get that. It was. While it was an amazing party, it wasn't a bachelor party. It was more of a friends and family party. So there was no arrests. There was no hookers and blow on this one anyway. It was family friendly, cigars and champagne and all sorts of fun stuff.
That's good.
No, it was good. You know what? You only turn 50 once, man.
That's right. I'm glad you're keeping a positive attitude. I personally hate birthdays, but I always say it beats the alternative of not turning another year. All right, Daniel, what's up with
Danny's coming. He's coming to Mexico. He's getting on a plane.
Actually, I have a question for you, Danny. Do you bring your Elon internet dish with you?
No, it won't fit.
No.
I don't think he covers Mexico. So
he doesn't like.
Are you sure?
Because he wants the wall to go up.
Pretty much, yeah. No comment.
But he's coming down. Tomorrow night we'll do some drinks out on the beach club. Sweet.
Sounds good.
Yeah.
And what is going on? You going to have something for your members? Like, are people coming to see you?
Yeah. Next week, have my mastermind where 25 members are flying down to trade a week along with me. It's going to be a lot of fun.
Jesus, that sounds like good. What's the weather like there right now?
It's like 32 degrees. It's hot.
Do you like Mexico or Portugal better?
I like Portugal better.
Do you really?
But I love Mexico too. Oh yeah.
Why is that?
It's an X factor of a whole series of different things. I mean, it's a first world nation, very safe. It has beautiful oceans, great surfing. Access to amazing seafood.
So one second. I got to interrupt there. How many times have you gone surfing, Patrick?
Quite a bit.
Come on.
I actually, I now own 2 surfboards. Got the body suits.
You never told me this. Like, this is true? Like, you're not lying?
No. No, it's I listen. You can't live in the surfing capital of Europe and not take up surfing.
That's awesome. So where do you go? Do you go like when I was there? I went to the place that was north. Where is the ECB meeting every year?
I don't know.
Come on,
Sintra.
you know. Sintra. Yeah, Sintra. So I went to a place north of Sintra that had like some really big beaches and it was very much reminded me of Malibu.
Oh yeah, the
is that where you go?
That's where the largest surf shop in Europe is actually.
Really?
But but it's an hour north of Lisbon is where Nazaré is, where the world record waves are. Where it's like the largest.
Yeah, but you're not going there.
I'm
asking you where you go.
No. I'm scared of 6-footers as opposed to fucking 110-foot wave.
Yeah. I didn't know that you're into this. So what size boards did you buy? It's like, did you just buy a big?
Oh, I'm still in the 7-footers. So like I have a 7.2 and a 7.8. So like I don't even know if I'll ever get down to like 6-foot boards. Like I don't think I'm gonna ever be that good, but
that's awesome.
I'm off the foam boards. I'm on the fiberglass now.
Nice.
So it's
well, you know our buddy Cuppy does a lot of surfing and
oh yeah, I'm 100% gonna go down and surf with Cup for sure.
I know.
I'm
gonna be the mope that doesn't know how to surf. Like I know how to surf a little bit, nothing like you guys. That's awesome. I didn't know this part of the story. That's great.
Yeah, no, Danny's going to learn to surf too. He's turning Portuguese in a month.
I know. He's telling me.
Oh yeah.
He's telling me, Patrick, Danny, are you happy? Can I say it? You bought a house in Portugal?
Yeah, go for it.
Okay, Danny bought a house in Portugal. His first house in a foreign country. Pretty exciting stuff.
Yeah.
Well, you know what? It's definitely more reasonable than trying to buy it out in the UK.
Yeah.
Oh yeah. I'd get a shack for this thing. Yeah.
And Danny, where do you surf on the southern parts? Like, is it because you're near the Algarves? So do you go to? Let me just look here.
You can go to Faro, or you can go to Lagos. I think is it Lagos?
Yeah, Lagos.
Okay. Because you need to be exposed to the full-on Atlantic side for the wind for the waves, right? Like,
which is not
that's
far.
more like.
You ought to be facing west as opposed to facing south. Like you can't go to the parts like on the south.
But there's still there's some pretty good waves actually still down there. I mean,
really?
Surfing's nowhere nearly as good as the Atlantic direct side, like going up on north of Lisbon and that entire side. But it's still more like on an angle, so you're still getting a lot of the Atlantic, ocean violence.
Okay.
It's not Mediterranean calm there.
I hear what you're saying.
No,
I get it.
Yeah.
So you can still, depending on which way the wind had been prevailing earlier, you could still get waves on the
Portuguese have some of the most beautiful beaches in the world, but they're all cold as fuck. Like there's no point in the year where you're not wearing a wetsuit.
Patrick,
like
you're talking to a Canadian. You guys,
no, it's cold as fuck.
I know, I understand that it's cold, but it's
like
not,
I'm just saying, like people should not come to Lisbon if they expecting warm, calm oceans.
No, I hear you.
That doesn't exist here.
No, I get it. And let's just go. But like, my son is picked up surfing, and he does it in Halifax.
Surfing on Nova Scotia, right?
Yeah. So Portugal. So let's just do Portugal water temperature. Let's see what it is. So I'm going to take the other side of your bet here. Water temperature. It is. It gets up to 20 degrees. Okay. And then Nova Scotia water temperature.
What a great after show, guys.
Yes, it is.
Why not?
Yeah, what the fuck? Nobody listens to this
anyway.
anyways.
Should hang. Yeah, exactly. Yeah. They should hang up if
it's
they don't
5 degrees. No, 10. It gets to 10.
So it never gets warmer than 10.
Yeah. So.
Well, okay. Yeah, okay. That's.
That'll get some hard nets.
There you go. Patrick's getting so soft in his old age. He's moved to Mexico and moved to actually Portugal, and now he's
fuck it. I'm never ever going to scrape ice off a windshield again in my life. That's the goal. Fuck that. Never again. Never gonna plug a block heater if anyone even knows what that is into the fucking garage.
Let's see if Danny knows. Danny, do you know what a block heater is?
I do actually. Yeah, it's where it runs overnight, so it doesn't freeze the engine.
Yes. How did you know that?
Well, okay. There's a little fun fact for me. I like this YouTube guy called Outdoor Boys, and he like lives in Alaska, and he just like builds like ice igloos and stuff like that. And he was literally talking about this like the other week, and I was like, oh, okay.
Oh, there you go.
That's funny.
Yeah, it's just like something that keeps the engine warm enough that the oil doesn't freeze.
That's right. So so I grew up in Winnipeg, and in there, everyone, you have a block heater. When you go to the parking lot, there's literally a place to plug your car in, not to charge it, but literally like in the 70s, there's a place to plug your car in so that the oil doesn't freeze. And when I got to Toronto, I was shocked because nobody knew what it was. Like the kids at school were like, "Why do you have a plug coming out the front of your car?" And I was like, "Don't you have that?" Like nobody knew it. Like it was just like they were like, "What the hell, dude? Like why are you?"
You ain't Canadian until you got the plug sticking out from the front of your car.
Yeah, I'm proud of Danny though. He knows what a block heater is. Outdoor Boys, eh? Is this a good show?
Yeah, I really like it. It's just some guy that just shows you how to live in the wild. So I'm into that sort of stuff.
Danny, the guy who grew up in London or outside London, and he's like,
yeah.
Have you ever? What's the most exotic, like wilderness-y place you've ever been? And if you say Scotland, then your cred's going down.
He was gonna say Scotland. Now he's scrambling for what the fuck he can say now.
To be fair, the Isle of Skye is pretty good in the Hebrides. That's like there's like nobody there.
Well, okay,
that's
I've been there, so I know, and that is not wilderness, buddy.
Okay, well that's all.
You gotta have a trip to Canada, and then you're.
By the way, we haven't talked about this, but Patrick, I don't know if you know this, but I was trying to figure out where Danny's from. I was going through it, and he's telling me, and I'm like, I don't recognize anything, and then he gives me the name. I look it up, and I'm like, holy shit, you live right near Jeremy Clarkson's farm. Like, we haven't talked about this. So for those who don't know, Jeremy Clarkson is the old guy from Top Gear, and he has this show, Jeremy Clarkson's Farm, and that's where Daniel's from. And I can't remember. Do you know the kid that helps with Danny with Clarkson's farm?
No, you asked me this. I don't know him, but he lives in the village that's like it's not far. It's like 20 minutes. It's Chipping Norton.
Oh yeah, that's it, Chippy. Yeah.
Chippy, yeah.
So
yeah, he lives there. It's like 15, 20 minutes.
Have you gone to his Jeremy's little store?
Yeah. I drove past not that long. I rarely go back, but when I do, then I went and had a little peek.
Oh, and it was his wife there?
I mean, I didn't meet him personally.
No, I don't care about him.
I kind of just drove.
I want to meet his wife.
Like, well, hey, I'm just wait for the wife. Don't worry about you, Jeremy. For the wife.
Who wants to meet him? I want to meet his wife. Oh my. Okay.
Yeah.
Okay. Well, listen. You know what? We're doing this early so that Danny can actually get going to Mexico. So we'll let you go, and so you can do some putting all this together. And we'll see everyone in a couple weeks. Thanks for tuning in.
All right. Cheers.